The Eastern Panhandle Board of Realtors presents Mortgage Panel with Jesse Prince, Eric Stinger, and Byron Reed.
Put together a PowerPoint, um, just some things to be aware of in the marketplace. So the way today's gonna work is just gonna do a quick breakdown of what's going on out there. Then we're gonna have some open discussions about what's going on with credit requirements, conventional loans, jumbo, non-QM, and government, all the different markets. How that's influencing products and pricing, and then we'll take an outlook for the industry as a whole. To start off, real basic. I didn't know where to start this, so I'm going basic on it. Basically, when you have a mortgage, you have the consumer. They go to the mortgage company, and then the mortgage company takes that, bundles it up, aggregates it, and sells it off to the bank or the GSE. It's kind of like an engine. There are different components of it. All of them are just as important as the other. You can have an entire car, but if you take out one spark plug, the car doesn't run. So in a mortgage, you have the actual mortgage, you have the warehouse that starts with it, the insurer, the bondholders, and then the servicers. The way that this works in a very nuts and bolts fashion is the borrower comes to a lender. The lender puts that loan into a credit line or a warehouse line. And then the warehouse line, they are really trying to get rid of that loan as soon as possible. They're selling that on down the line. They've got a buyer for that loan one way or the other. If that loan gets stuck on that warehouse line, it's just like a checking account. You only have so much money in that warehouse line. If that loan, as long as that loan is in there, you can't do other loans until that loan is moved. So if that loan doesn't move out of the warehouse line, it definitely impedes the lender's ability to continue business. You have your borrower, they originate that loan and it goes straight to the aggregator, the company or investor. And then you have your GSEs, your insurers, Fannie Mae, Freddie Mac, and Ginnie Mae. They're guaranteeing the performance of those loans because most of those loans are underwritten to one of their guidelines, one of those sets of guidelines. So if they say, hey, if you underwrite to Freddie guidelines, we will go to we will insure that loan and its profitability because we have given you the guidelines to underwrite it. Once it is insured, then it goes to a servicer. That's the people that everybody makes their payments to. What the servicer does beyond collecting payments and taking care of the customer, they also make sure that that property stays insured with the escrow account. The taxes on that property are paid, because if the taxes aren't paid, tax liens go in front of the lien holders. They also guarantee payments to the bondholders, the end investors. They are giving them a profit. Otherwise, nobody would invest in mortgage-backed securities. They have to get a profit, and the servicer promises them those returns. All that has to happen even if the borrower doesn't pay. So if the loan is paid off or refinanced or foreclosed on, it's out of that bond pool. Until it's out of that bond pool, they still have to pay all of those things. Servicing is all about scale. Basically, a servicer really expects the loan to stay on the book 8 years or so. They don't really start making any money until they've held that loan for about 2 years. And if there's a prepayment or a default, that really messes up their profit levels. So what we have gone through is we went through a dramatic rate drop, which put a ton of new loans on the books. People were refinancing very quickly, getting all those, so the servicer's profits were down. Then you also have, with this COVID virus thing, people are losing their jobs. There's scare of default and then the forbearance thing, which I'm going to get into here a little bit more. But yet the servicers have to make all those payments no matter what. So you have to look at who is least or most likely to stop paying their loans. Is it going to be the people with good credit scores, low loan to values, and good reserves in their bank? Or is it going to be the people with the higher loan to values, the low FICO scores, and not much money in the bank? That's basically describing all the government loans, all the VA, FHA, USDA, very little money down, marginal credit scores, and low to no reserves a lot of the times for those buckets of business. This is the jobless rate that we have seen going in the past. And as you all know, that's what has just happened. So there's a huge scare out there with the forbearance that the government has put out there, that a ton of people are going to take advantage of that, putting the servicing industry on its heels. So what is it going to take to get out of this? Servicing is going to have to come back and feel stable, that they're going to be able to get paid. The job market's going to have to come back. Forbearances are really going to have to feel that this isn't going to hit them. The servicers are going to have to feel that those forbearances aren't going to hit them as hard as they're afraid it's going to, with the unemployment rates and the jobless rates going up. The forbearance as a whole, that's obviously a good thing. The government has tried to do something very good for all of the consumers in America. But the problem is it could really mess up the entire mortgage industry if that gets abused or overused. The servicers can't make those payments because they don't have the money going in, and that's the real scare. If the forbearance happens before a first payment defaults, then what's going to happen is these loans are going to go back to those warehouse lines. Those are going to be stuck with the lower investor because they will not be insured by the FHA, Freddie Mac, Fannie Mae. Fannie Mae and Freddie Mac have said they will, but the government, Ginnie Mae, has not. So they'll go back and get stuck in that tranche at the warehouse line. Forbearance is not a forgiveness. That will have to be paid back at some point. So while this is a great thing, if somebody is in trouble, it could really put them behind the 8 ball, and not everybody really understands that is a reality. This is just a quick slide that I borrowed from a presentation I saw, and basically, if you put off those payments for 12 months, that's great, but they're going to add it right back on. It's got to be paid back. You have signed a legal note that has to be paid off in a certain amount of time, and they don't have the right to extend that note. So they can't just put it on the end, tack it on the end. It's got to be paid off before that note is extinguished. So the forbearance is something that it could really upend the industry, and it's going to have a lot of plague going forward. It hasn't been totally figured out by the government, and everybody's still looking for some guidance on that. This is where we are, average FICO scores across different loan segments. The average loan scores or FICO scores for FHA loans, as you see, is much lower. VA is a little bit higher, but conventional is obviously the highest of them all. And therefore, the conventional market is clearing up faster than the other markets because the servicers and the aggregate companies are not as concerned with those. This is from Zelman and Associates. They're predicting that only a 2 to 3% value decline in properties. And the reasons for that is right now we have a very low inventory, as you guys well know, in the real estate industry. This crash or economic bubble compared to the 08, the loans that we have been putting out are much more stable than they were going into the 08. So they're there is a belief that the loans will not be as much of a problem as they were in '08 because there was much more money put into loans to buy houses, much more concern with the underwriting process. The credit availability was watched much closer, and we continue to have low rates, so it'll continue to make housing affordable for those that can get into the market. And that is the last slide that I have on that presentation. Byron and Jesse, do you guys have anything that you could add to any of that for us?
I mean, I think we could all add for days and days. We probably have stories to tell to back all that up, right, Byron?
Absolutely, absolutely.
It's something that's going to continue to. I was just on a phone call this morning. The thought is, as far as the industry, it's something that's going to continue to find its way out through the following months, and it probably won't find its way until June or July. So pricing and lenders coming in and out is going to be just the new normal as to how things are going. So that being said, let's talk about Jesse. Why don't you lead us off with what your take is on the new credit requirements? What are you seeing? How do you feel the market's going? What direction, and when we might feel any relief from that?
Well, I think it's all kind of relative, right? So we're all experiencing, as lenders and as realtors, kind of the trickle down effect of what's happening in the market. And I think it's actually maybe one of the things I've been trying to focus on through all of this is the silver linings associated, right? So the silver linings of the quarantine. My cooking game has been like on point lately. So, but as it relates to mortgage land, the credit scores the credit score requirements are increasing, but I don't necessarily feel like that's a bad thing. At the end of the day, what we're doing is trying to put people into homes that they can afford. And ultimately that does become a product, but I've been trying to think of an analogy for this. And those of you that know me know that I love analogies, but it's kind of like we're a bakery, right? So I'm the baker. I love helping people craft their cakes for their weddings and the kids' birthday parties, but maybe I'm really not great at making anything other than bagels. And we know that bagels will sell. So I've over leveraged all of my wholesalers for flour and sugar and all this stuff. And I make really terrible cakes, or these cakes are, end up being something that someone doesn't want to buy. So we have to be mindful of two things. We need to make sure we're making a product that people enjoy, which means in our case that they can actually afford to pay their mortgage, right? That's super important. Someone said to me at the very beginning of my career, and it's something I've really latched onto, that responsible lending is one of the highest forms of community service. And I strongly believe in that. And when we're doing things in a responsible manner, that has a lot of trickle down effect into communities, into the lives of the folks that we're helping, building families. I mean, even if you get so micro as to talk about, a kid actually having their own bedroom that they can go and decorate and feel that sense of security. So we have that really warm and fuzzy on the front end. But I think there's really going to be some silver linings associated with making sure folks are in a credit worthy position, maybe in these higher credit tiers, so that they are more likely to have long-term success in that mortgage. So I realize that at the end of this is our mortgages that we're originating are being packaged for secondary, and there's a profit margin to be had there. But the whole scope of it is really important to consider as to why these changes are being made. It's not as palatable as a product. The 580s, the default rate on those FHA loans, we have historically offered that low FICO product. The default rate is 4 to 5 times. So as an investor, that's not very attractive, right? But also as a family. I mean, if someone is not yet credit ready, it becomes a little bit of a square peg, round hole. I know all of us here involved are more than happy to work with folks on their credit. Credit scores are reflective of payment history, right? The best predictor of future behavior is past behavior. And that applies, per Dr. Phil, but also per credit scores. So it's important to be mindful of those things as well. So I really do think there's going to be some silver linings to be had here. I know all of us are poised and ready to help cultivate maybe a stronger pool of buyers. And one of the side effects of all of this is that we're going to have an opportunity to educate our clients and really solidify those relationships across the board with our partners. And yes, there are going to be pricing considerations involved with these higher credit scores. Low credit scores, we can still originate at 640 on our government products, but you know, the investor appetite is just not really there. So you're going to see that reflected in your interest rate pricing. For you as realtors, that means it's a source of a lot of the phone calls I'm getting, which is, why is somebody asking me for 6% on this FHA $180,000 transaction? And that's what you guys are going to feel. You're going to start seeing an increase in closing cost assistance. So mortgages aren't necessarily more expensive to originate now as a whole, but individual credit profiles and specific FICO bands are going to bring new challenges. And I encourage you to really lean on your lender partners as a resource as it relates to that when you're crafting an offer, to make sure that you're not over or under asking and leaving money on the table. So I could go on and on, but I'll let Byron have at it.
Hey guys, I'm glad to be on here. I mean, I can't disagree with anything Jesse and Eric are saying. The presentation was pretty spot on, Eric, on how to break this down for everybody so you can understand it a little bit better with how the mortgages are sold and all that. The biggest thing that we ran into was 6 weeks ago, guys. I mean, at least in my world right now, we are back on a playing field, know all the rules. We are ready to rock and roll. Most of the people that I've had to have very difficult conversations with were people that were under contract. Anybody that I'm pre-qualifying right now, they've already been contacted and said, these are the new rules and guidelines. Sorry you didn't buy a house 30 days ago, but these are the new rules. I know I told you at that 630 you were good to go. We are now back open to 620s on case-by-case basis. They're very difficult because it's still hard to get an approved eligible through Freddie, Fannie, or Ginnie Mae. The biggest thing that we've had on our end of the stick that's been a huge change for us is we are Ginnie Mae approved, okay? So again, that makes a huge playing field that is different for us because we're selling directly to Ginnie Mae right now. So again, a lot of the hurdles we've kind of knocked out of the way with that kind of stuff. The problem is with Ginnie Mae, and he was telling you, Eric was on that thing, Ginnie Mae has some strict rules when you're a lender, okay? And that means for the 30 years you have that mortgage, if that customer defaults on that mortgage, we are 100% liable for that payment, not the client. So they make the rules a little bit more different on us. But in theory, guys, I think like Jesse and Eric were saying, I mean, we've got the game plan now. We kind of know what's headed for the next couple months. Don't know when it's going to ever go back. I truly believe it's just like 2008. I'm originating loans just like I was in 2008. Eric, we've said this before in many meetings together. I do sometimes feel like I might need blood and urine before it's all over with. I mean, like literally, they're going to ask for everything known to man on these loans right now. So again, we're going to grind through it, guys. Everybody that I'm looking at right now, it's no different than when the bubble burst for us. They tightened up the new skies. Everything right now, they're just looking at it very carefully and making sure you are credit worthy to buy this home. If you got reserves, if you got good DTIs, all of that's going to be major impacts now that we were able to slide by for the last couple of years and get by that stuff. We're just not getting by that stuff anymore. So again, I did do a little breakdown. I did a video of this, but I just want you guys to hear this because everybody is down and there's a lot of people just kind of bummed out. But if you look at the big picture here, I mean, there's not a lot. Unfortunately, with COVID, if you've dealt with it family-wise or friend-wise, I have personally. I've actually lost 2 people. So, again, it has touched the home base for me very, very close. But at the end of the day, there's a lot other things that it was worse in 2008 than even close to what it is today, guys. So if you, just for a second, real estate in 2008 and 2020, the difference as of January 1st, okay? January 1st of 2008, there was 20 months of inventory on the market. We would love to have that right now, guys. I promise you, we would love that. So at the beginning of this year, we were running at a month and a half of inventory. So again, you can see that difference already in 8 and 20 just there. The Dow crashed in 2008 from 11,000 down to 7,000. Okay, the Dow crashed in 2020 from 28,000 to 21. We're still over 10,000 points ahead of where the Dow was in 2008. So if you look at where we're at, guys, it's not as bad as they're really making this out to be right now with what you're seeing on the news and things, if you want my opinion. Also, interest rates in 2008 were at 6.5%. I know every one of us has got 3 and 3.25 right now all day long. So again, you can see that huge swing also in the rates. The thing that Eric pointed out, unemployment. Unemployment was at 10% in 2008. Before all this happened, we were running at 3.5. So again, there's a lot of positive things, but again, the lack that I see here of the cause of all of this, in 2008, it was greed and the lack of regulations. There's only one thing I can tell you that was the cause of this, and it's called COVID-19. So again, I do think once we get over these hurdles here, it's just going to be a little bit backwards for us where we were at. And I mean, we're just going to have to make sure the clients stay on top of everything. Little tiny things are just not going to be easy to get around right now, guys.
Well, and I'm going to pipe in and just add to that. I absolutely agree with both Jesse and Byron on that. To steal off of Byron's analogy, it is a new playbook. It's a new rule book that we're all playing by. We've all, gotten our new marching orders, what we can't do. We're still doing loans. They're still out there, but what we can offer has changed. And to take Byron's analogy a little farther, we went from an option quarterback to a pass only quarterback, a pocket quarterback. I mean, we lost half of our playbook. There's some things that we could do 6 weeks ago that just aren't going to be able to do anymore. Jumbos are very few and far between right now because high risk associated with them. Non-QM is, we weren't necessarily involved with non-QM, but it's basically non-existent now. I got several calls, and I'm sure Jesse and Byron did too, of people that, had a loan and then all of a sudden didn't have a loan. They were going to closing and then they couldn't go to closing because they were with a non-QM lender. And there was just no way to fit them into a conventional type of product. I think it's going to be, you're going to see a lot more hurting towards the vanilla, towards the middle of the road lending that we saw for a long time until they figure this thing out, until the government gets in and does some more support on the servicing end, especially in the government sector in Ginnie Mae. Once that gets propped up a little bit and there's more stability there, you'll see that open up again. But right now, conventional, money down, good credit scores, money in the bank, that's always been the A name of the game, and that's where it's going to right now for the best types of rates. There's still stuff out there, but as Jesse alluded to, we can still do the 640s, the 620s, but they're going to pay for that. It's going to be a higher price. They're not going to get that same price that the A+ borrower is going to get anymore. And going to that, one of the things on the list that we had is just changing products and pricing. I mean, I kind of alluded to it just now, what I've been seeing. Byron, I'll let you kick that off. Have you been seeing basically the same thing or seeing anything different as far as what products and pricing or where they're going right now?
I mean, right now rates are staying as low. I mean, we're seeing a trickle every once in a while of an 1/8 and a quarter in rate, like back and forth a little bit, just with the market going up and down a little bit, guys. I do believe rates are going to stay very low. That's just my theory. It doesn't mean I'm right. I mean, when the government drops prime down to 0.25%, they're going to keep the rates. You're going to have to see that number start climbing before rates will actually change. I just don't know when we're over it. That's the catch. And I know everybody on this call is waiting for that answer too. But I meant, is it 2 weeks, 3 weeks, and we hit it again and we go backwards and sit at home for another month and a half? I don't know, guys. I mean, there's going to be some hurdles here with guidelines and changes. It's pretty simple now. I mean, it's just quality control, the best I can say it, guys. I mean, you just got to make sure you're reviewing everything, little tiny credit hits. Like, here's a prime example that never got me in the past that I'm seeing a lot more of now. In the past, the only thing you could ever really be late on with me was a mortgage payment. If you were late on a mortgage payment in the last 12 months, it was going to hurt you, okay? Well, if you've been late on credit cards, student loans, car payments, many other things in the last 12 months, if you don't have a very good reason for that, they're going to eat you alive on that too right now. Those are the type of, like, we're talking about the changes. That's the quality that they want. Like, for example, Margie, why were you late on that car payment in December? You know what I'm saying? Like, what was
It was
the reason?
Christmas.
There you go. We've heard that many times.
Actually,
Come
so-
on.
Yeah.
But those are type of things that, for me at least, and you guys can speak up, Jesse and Eric, I mean, I didn't have to worry about lates on anything but mortgages. I'm just saying, when I'm running things through automatic underwriting, DU, LP, Jenny, those are the things that are triggering things right now that's giving me, instead of approve eligible, to a refer eligible. With the wholesale lines and stuff that we're dealing with, we only have so many people that will take a refer loan right now. I mean, it is, when I say little, I mean, we got like a handful compared to where I have 32 investors I can sell my loans to. So I mean, you go from a huge span here down to real quick. So again, those are the type of things that I'm seeing that are a little more difficult. But it is so much rate is based off of credit score, and it's pretty tiered out this simple. 720 and above, you're going to get the best rate you've ever seen. 720 to 680, you're going to have a great rate, but it's probably going to be about 0.25% worse than that 720 person. If you're under 660, 640, we're still very, very, probably 0.5% to 0.75% off, but there is a chance you might be charged a point. There is a chance, just because, again, it's very limited right there. But again, FHA and VA, I feel like, has been more generous to those clients. USDA, woo, they're not really generous right now. I mean, they're pretty strict on their rules right now, guys. So again, 2941s, they ain't moving an inch off that, at least what I'm seeing. You guys please chirp in and tell me if I'm off at all, please, please. But again, that's what I'm seeing right now from my end, guys.
I missed the West Virginia State USDA office. If you guys don't know, USDA's moved to the national office, which has extended your turn times on loan commitment. So if you felt that, that's why. But yeah, they don't budge very much on anything in the national office. And Byron mentioned that Fed overnight rate. You guys are probably hearing, I got a request yesterday for one of those 1% loans. If you guys find one of those, just let me know. I take 3 or 4 of those myself. But the Fed overnight rate, that created, I'm sure, a lot of phone calls for all of us as lenders. Obviously, that's going to be different than what we're seeing in terms of mortgage interest rates. And shortly after the Fed dropped that rate to near zero, in comes Corona, right? And so when clients are like, well, why is my rate not zero, or why is it now higher than it was last week? A lot of that has to do with what Eric mentioned in the beginning, right? It's when we get to the secondary and that market is stalled or non-existent and you can't clear the warehouse lines. There were lenders out there who had to manage their pipeline by increasing the rates to essentially slow down the flow of loans, or otherwise vet out those loans. So I think the rates are going to be tied to what's happening in secondary until we get all of this forbearance issue and kind of this overly, I don't know what, gracious offers to just don't worry about paying your mortgages, from the powers that be. Understandably, that spooks off an investor who wants to buy these mortgages once they're originated. So I do agree with everything that everyone else has kind of commented on to this point. I will say, again, I think there's some silver linings to be had here. It's a great time to educate not only your clients, but yourselves. There's some resources online. I don't know if anyone listens to anyone even as simple as Tom Ferry, Keeping Current Matters. That's a great Facebook page. If you guys aren't tuned into that, they do a really good job of chunking down this important market-driven information to help you guys position yourselves as resources, as experts in your subject matter. And it's a great time to really distinguish yourself in that way by using those resources and taking the time and be that small differentiating factor to really, the people that are making the extra effort now in this wonky time are going to be the ones that come out 2 steps ahead once everything's easy breezy again. And I think that's the point that we were at, excuse my poor grammar, before Corona struck us. So I encourage everyone to take this time to embrace the silver linings, not to sound like too much of a Pollyanna, but what else do we have? We got to focus on what we control And education and knowledge is power, and it's a cliche for a reason. So if you guys have any questions about any of this, I'm sure all three of us and any of your other trusted lender partners would be more than happy to help you navigate those conversations with your clients, because they are important, and it's going to save all of us a lot of angst if we're all kind of on the same page. Like, we can help you get into a loan. I want to help anybody that wants to get into a home get there. There's going to be some extra patience required, and there's also going to be some extra time considerations, financial considerations. And it's a great time when we're all sitting at home with access to the W-2s that are somewhere in a box, to really start putting those plans into motion. So if you have your no's, not nows, and maybes, get them on the phone, get them prepped. It's perfect time to be building your pipeline for 3, 6, 9, 12 months from now.
Well, and just to circle back around, I absolutely agree with both Byron and Jesse. The two points I wanted to hit on that they both kind of touched on. One, you're going to see the use of points a lot more for right now, at least. A lot of lenders are requiring points, especially for those FHAs, USDAs, VAs. So make sure and have those tough discussions with your lender partners, that you are aware of what it's going to take to get your client to the finish line, because that can change as daily. Just once they're locked in, then you're okay. But until they're locked in, they might be carrying around a pre-approval that they think is great. I've had a couple people come to me with pre-approvals from other places that were 20 days ago, 30 days ago, and that pre-approval is just non-existent anymore. They can't get that loan. They're looking for that 2.75 rate on a purchase, and it's just not there right now. The other thing is be very aware, and I know Byron and Jesse are both professionals, and they're having these conversations as well. But as realtors, have these conversations with your clients, that how stable is your job? Is there a chance you could be furloughed? Because if they are furloughed during the process, they're probably not going to get that loan. I don't know any lender out there that's going to close, and they are checking more strenuously at the very end of the process now for income, for credit changes, inquiries, to make sure that borrower is the same borrower at the very end as they were at the beginning. So if there's a chance they could get furloughed, we need to know that up front and be prepared for that. It's all going to be, it's going to be hit and miss. Just be very communicative with your borrowers and your clients and your lender partners. Tina, you had your hand up.
How long before, after they go back to work? Is there a waiting period of time after the furloughed?
At this time, there's no been clear direction of that yet. I mean, I have not heard any clear direction on the time frame they have to be back. Maybe Eric and Jesse have, but I have not heard one. They have not came out with that on my end at all.
If it were a Facebook status, it's complicated. I think it's kind of the short answer to that. So, I mean, we need to be able to verify that you're back. So ideally, if it's the same job, we can kind of explain what's happening to all of us. Same job, same employment or income hasn't declined, rather. It doesn't necessarily mean another 30, 60, 90 days. It really comes down to what that updated verification of employment looks like. Were they full-time and now back to only part-time? It really is, it's going to be a case-by-case vetting process in most cases.
Yeah, and what we're seeing, the way that we've been told is at least one full payment pay stub, full payment cycle. We should be fine with that with all of our investors, as long as they have one full payment cycle. The other thing, just to kind of piggyback on that verification at the very end of that process, the verification of employment, that human resources person is probably working from home. So a lot of times they're not that easy to get a hold of. So have that conversation as well with your borrowers. I mean, that's our job, but just to key you in, that's something that we are struggling with a little bit, is getting that person on the phone or getting them to fill that form out at the end. So, yeah, Christine.
I've had a couple of clients that they're not being furloughed, but they've been taking pay cuts between 10 and 20%. And they're being told that this is just like a 4-month thing during this corona epidemic. Now, how would that affect if they're trying to get a loan? And they're saying they will get their pay increase back, but who knows if that'll happen.
I think that's, I mean, Jesse, Byron, you correct me if you guys have different, but I think that'd be a case by case. And I think they're going to go off of what they're currently receiving when that loan closes. And it doesn't matter. Just like somebody that's going to become a doctor, we can't give you a loan on your $500,000 income until you're actually making it.
Yeah, I agree. A lot of the loan programs have modified or eliminated the future income considerations as well. So I don't know that there'd be any reason to expect that we could use future income in this case at all. It's definitely going to be current. I mean, and a lot of our income guidelines are based on continuance, whether it be child support, your current job, full-time employment, et cetera. So continuance is going to be the biggest question and biggest probably determining factor as to why we would need to use that lower or reduced salary for qualification.
How close is Credit Karma to the actual?
Like all three of us laugh. That's great.
The way I always tell my customers, Credit Karma is like a thermometer that is just off. It'll go up if you have a fever and it'll go down if you're cold, but it's nowhere close to the actual where the reading should be. That's about the best I can say. It's just a barometer.
So it means nothing.
The best thing for Credit Karma is to monitor your credit.
Somebody that's building their credit and they're in, they're working on it. If their Credit Karma score goes up through this process, it means nothing. They need to check back in with their lender.
Well, absolutely, but not necessarily. I mean, if it's going up on Credit Karma, most of the time it's probably going up in theory. It's just Credit Karma can range 80% of the time, it's 30 to 40 points higher than what your actual score is. Now, I say that, and I'll have a client walk in an hour, and I'll pull their credit, and they'll say, Credit Karma says 650. And I'm like, oh, God, I'm probably under a 600 here before I even pull it. You know what I mean? But I've pulled those, and it's been 700.
Yep.
So the easiest way I tell people, if you took a pie chart, okay, and you made 4 different blocks in that pie chart and said payment history, inquiries, utilization, length of credit, and all of that, and you broke it down in percentages, okay? The financial world uses certain percentages to come up with your FICO score using those different scenarios, such as your history, utilization, and all that. Credit Karma, they don't use the same percentages. So like they might be real heavy on if you make your payments on time, but don't really care if you got inquiries or collection. Like the way they come about it is just totally different. But I do tell clients, it's free. It is great to monitor because if Jesse takes off with my credit card and starts using it like crazy, that is, I figure I'd get a laugh out of that. If that happens, I am able to watch that. You see what I'm getting at? So there is a perk, but when it comes to credit score, I tell everybody, hey, once you meet your lender, there's your credit report. I meant reach out to them because they're going to keep you in the right direction.
Margie?
Explain the re-verification. I'm assuming it's going to happen after disclosure, CD disclosure.
Are you talking about employment?
Yes. And how does it have, I mean, is clear to close issued before that?
Yes.
Yes, and clear to close is going to be issued before that. They're going to recheck. It used to be, and it might that might vary slightly. I guarantee it varied between company to company before, but now Fannie and Freddie have really come in and tightened it down. It's going to be usually within 3 days of closing that you're going to have those verifications done and made cemented.
Okay, so my instruction to an agent has always been, if you have clear to close, we are good to go. But that's really not so now.
Nope.
Margie, you can have the issue, and I've seen this now twice that I've got phone calls on, okay? Literally bawling, okay? And I'm just, fingers crossed this ain't smacked me in the mouth yet. Because, I mean, I feel like, Eric, all of us could happen to us, and it has none of our control, is that underwriters are running a final DULP and any Gus, literally, before they put it in CTC, they run it one more time. And I've literally had clients call me, say, Byron, they just told me that I got everything turned in and I'm getting ready to get clear to close. And now they're telling me I'm not approved, I'm referred, and I can't buy my home. And I'm like, they're tweaking the guidelines like that. And I mean, it's scary, guys. Luckily, I mean, again, I got my fingers crossed that that has not happened to me yet. But it could tomorrow. I mean, literally, that's not in a loan officer's control what the guidelines from DU and LP are telling.
And realistically, the reason I bring that up is it's always a concern. It's certainly not as big a concern for me as the broker on a property that's empty, but it's a big concern for me on a property that everybody's got moving vans coming and going.
Yep.
So I think if any of us can carry any story back to the consumer, it is to every consumer. You don't own this house until you walk out of the attorney's office. And very frankly, I'm not so sure we shouldn't be using contracts that are possession the day after closing.
Yeah.
Because very frankly, I think we've been very lucky. We haven't had any sellers move that we had this issue, but this is scary to me.
Well, and then there's a whole another layer on the income verification now. It's always been just a little bit different for the self-employed person. Now it's totally different because not only do we have to look at those last 2-year taxes, they want to see what's happening today on a self-employed person. They want to know that their industry hasn't been influenced by this and that they still have that income. And to actually prove that sometimes gets a little hairy.
Oh, for sure.
Byron?
So we have one right now that we're looking into very heavy right now. So there's a catch at least that we're catching with the PP loan that everybody was getting, small business. All right, to take that loan, it states on the application, you are having a hardship. So if you took that loan, I have not ran into it yet, but there is a possibility that could red flag you on a loan now.
You're talking about PPP?
Yep.
Yeah.
So
and I agree.
You
I
don't,
completely
I
agree.
mean, at least unless y'all have heard, anytime you two chip in with me, please. I have not heard anything about what the cause of that's going to be for self-employed people. Because I can promise you, the majority of people took it.
Yeah, there's a whole lot of uncharted waters that we're all just going to be going through together. And, Byron said it, Jesse said it, and, I'll say it again, just stay in close contact with your lending partner because these things, and Jesse and Byron and me, and none of us want to tell you at the end, hey, this one's not going to happen. But because we're all fighting for the same result. And if we give you an approval and we're fighting to get it done, we're planning on it getting done. But it's a different war out there these days.
Last thing
Really scary for coinciding settlements when you've got one person buying another house and oh my God.
Absolutely. Yep.
Absolutely it is.
Guys, hey, Byron, Jesse, you guys did great. Thanks, everybody. Yeah, Byron, Jesse, we're here to fix problems. So if you have any problems, reach out to us. And I'm sure I can speak for them on this. I don't care if you're working with Countrywide or some other company or, Rocket Mortgage. If you're having trouble, I'm a mortgage professional. I'm going to help you. And if I get the loan, that's great. But if I don't get the loan, I want to see you get the house. I want to see you get your loan. So we're here to help. Just know we're a resource. Amy, are we ready to wrap her up?
Thank you, Byron, Jesse, and Eric, for agreeing to do that. Thank you very much.
Thank you, guys.
Thanks, everybody. Sorry I was a little late coming in.
Be safe.
You all take care.
Thanks.
All right. You too. Bye-bye.